GM, good morning. Welcome to the Milk Road Show, the daily crypto show where we break down crypto smoother than finally realizing why you walked into that room. I'm your host, Jay Hamilton, and today we are joined by Nick Van Eck, CEO and co-founder of Agora Stablecoin. That's AUSD. In today's episode, we will discuss the past, present, and future of stablecoins, starting with Tether, leading up to today's yield-bearing stablecoins. We're going to talk about what stablecoin could win in the end, what is that product going to look like, and we're going to finish with most stablecoins are all private companies. So as an investor, how do you get exposure to them? We're going to talk about the different ways you can do that. Before we jump in, we are so close to 10,000 subs on YouTube. And if you subscribe before we hit 10,000, you could win thousands of dollars in free prizes. So make sure you subscribe today before we get there. Also, we got to give a quick shout out to our friends over at Uphold. Meet Uphold, a trading platform that's changing the way you think about money. Imagine this, earning up to 4.9% APY on your US dollars. No catches, no lockup periods, and no fees. And yes, it's FDIC insured up to $2.5 million. But it doesn't stop there. Uphold is a global platform with over 10 million users in more than 150 countries. They offer access to over 300 digital assets, which you can trade, store, and exchange with confidence, knowing Uphold operates with a 100% reserve and a transparent model. So how does it work? Create your account, fund it with a few taps, and you're ready to go. Want to learn more? Click the link in the description and join Uphold today. Nick, welcome to the Milk Road Show.
Thanks for having me.
Very excited to have you, Nick. I want to start off. You've been on a bit of a tour recently, given a bunch of talks at Permissionless and at Token 2049. So respect the hustle, my man. And one thing I've heard you describe well is just sort of like the eras of stablecoins, going back to like the beginning of stablecoins up until today. Can you sort of give us a breakdown of the way stablecoins were first created, what that product looked like then versus what we are seeing coming from stablecoin product creators today?
Yeah, happy to do so. We actually just, I think, passed Tether's 10-year anniversary a few weeks ago. And so Tether was really one of the original stables. And they were instrumental in bringing digital dollars on chain, and in many ways were and continue to be visionaries in the space, right? And back then, it was primarily used as a tool for traders to move money, from exchanges, but also to replace BTC as the quote token or collateral asset on exchanges. So Tether got going 10 years ago. Then you had really this big crop of exchange-backed stables get launched in 2018, 2019, with projects like USDC, which was done in partnership with Coinbase, BUSD, which was done in partnership with Binance, GUSD with Gemini, and the list goes on. And these were primarily single partner model stablecoins, right? So all of the rent accrued to the exchange that was backing it, right? And our view is that the market structure has changed dramatically since then, right? Even in 2018, 2019, the primary use case was to replace BTC and other assets as collateral and as the quote token on exchanges. I'm not sure when you got into crypto, but I remember in the 2016 days, like everything was denominated against BTC, right?
Mm-hmm.
But the landscape has changed dramatically since then, right? In 2018, 2019, you hadn't had DeFi summer, right? You didn't had this explosion of multiple different chains, multiple different VMs. And our view is that these single partner models don't make sense because liquidity and utility for stablecoins is driven primarily by other businesses and their users, right? And in today's world, everyone else is really cut out from this economic equation other than Tether, Circle, and Coinbase. And I would say even in the USDC case, more perniciously is, Coinbase is now competing with pretty much everyone, right? And for every dollar that USDC generates, whether it's on Solana, in Fireblocks, on Bybit, half those dollars and that revenue is going to Coinbase, who has a chain, they have a wallet, they have a custodian, they have an exchange, prime broker, etc. And our view and specifically, like I was like looking at this, I was like, this is like wrong, right? Like this is like almost worse than banking, right? And so I was sitting at my desk a little over a year ago and said, okay, like we need to change this. We need an institutional grade, credibly neutral stable coin that can partner with all these businesses. And so that's what we do. We use one of the largest GSIB banks as our cash custodian and fund administrator, and then we go to applications, exchanges, fintechs, and say, hey, you're actually the ones that are driving a lot of this value to these monetary networks, and you should capture the majority of that. And so we share 50, 60, 70, 80% of the net income with the end business, right? And that could be an application like Aave, it could be an exchange, it could be a custodian, it could be a payment company. And that's the beauty of it. It's super flexible. Like regardless of the business, we're a one-to-one stable. We KYB that entity, sign the agreement, and then boom. We track everything on the back end, pay cash flow to these businesses, and then give that business owner the agency to decide what to do with it, right? It could be improving the security of the product, reducing on and off ramp fees around AUSD or other assets. Using it as marketing spend to drive more usage to AUSD vaults or whatever it is. And so that's sort of, where we've come from and where we are today. And we really are, believers in this sort of stablecoin 3.0 thesis that Agora is leading, which is like, 1.0 is Tether, 2.0 is these exchange-backed stables. And, this is the ultimate model, which is an open model where we can work with any provider, right? And then they join this network that has really broad utility and liquidity. They don't have to run their own stable, but they're making the economics as if it was their own stable, right? And so, yeah, that's a little bit of the backstory there.
Yeah, I love that. And there's obviously so much potential. And I think we all see this with, if you haven't seen a chart about the revenue or the profits that Tether is making, then you're probably living under the rock for the past few years, because they've just been absolutely crushing it. And so we're all aware now of like, oh my gosh, look at this incredible business. It's the killer app of crypto so far. Stablecoins is clearly here to stay and clearly has so much potential. But then you look at all the profits being made and you're like, okay, well, why don't we share that? And so the one thing I just want to understand quickly is, what's the difference between, I think a lot of our listeners will understand more like a blast stablecoin, which is aiming to share yield native with the user. And that's different than what you guys are doing at Agora. Can you explain that difference for everybody?
Yeah, that's exactly right. So we are one-to-one. And one of the challenges with yield-bearing stables is they're pretty clearly security products in like 70% of global capital markets, right? So they'll never be issued on exchanges. Payment companies can never really use them. And so that really lowers the ceiling of utility and the users that you can address. And if you're a stablecoin, you should be trying, or at least trying to become global money like we are, you should be maximizing utility and liquidity. And so it's very clear that you need to be a one-to-one stable. So what we're doing differently is going to all these different businesses and providers and saying, hey, KYB with us. And then what we'll do is we'll share the majority of the income with you as the business owner, and then you can choose to do with it what you want, right? So let's like use Aave as an example, right? The Aave DAO would KYB with us. We track the smart contract address where the AUSD balance is sitting. We know exactly on a block by block basis how much AUSD has been in that address, and then at the end of the month, pay them, right? And then they can choose to do with that cash flow what they want. The same is true for exchanges, custodians, whomever. And we have a pretty broad network now of over 55 actually today businesses and applications that are already onboarded with us. We have another 100 plus in the queue, and ultimately, we want to have like very broad coverage, right? And it's sort of like the Pareto principle, where it's like sort of 20% of these participants drive 80% of the activity, and so you get great coverage, and then ultimately AUSD is going to be the best stablecoin product for you, regardless of the environment that you're in, whether it's a centralized exchange, an app, whomever, and it's super flexible because it's compliant with these regulations. And so that's the main difference between us and like a yield bearing asset. The one other point I'll make is that these yield-bearing assets really don't have much margin. When you're a stablecoin issuer, you need to be funding liquidity programs, driving PD, tech development, compliance, and that's expensive. And that's sort of why we think this is the right sort of threshold where, we keep a small spread and then pass it through, the majority to these businesses, because then we can go build that network for them, right? And then instead of having, hundreds of different teeny stablecoins where people are trying to build out their own network or liquidity program, which is really hard, everyone can just sort of opt into our money network, capture the majority of the value, and really have to do nothing. All they do is just implement the ERC20 token, and then boom, you're ready to go. And so it's super easy. And this is what we think the world should look like, right? As opposed to tens of billions of dollars getting sucked out of every year to Circle and Tether. It's us pushing it back down to every single business that's operating across crypto. And ultimately they'll build the best products for their users around AUSD.
Right. And so just to make sure we understand the regulatory difference here, because you are offering the incentive or the payout or the revenue share, whatever you want to call it, to the businesses that you're working with, you exist around regulatory issues. Whereas if you are offering yield to the end user, now that causes regulatory issues. That's correct?
Yeah, that's right. Exactly. Right. Because we're KYBing anyone that we're paying. Right. The issue with these sort of non-KYC yield-bearing assets is, one, there's security in a lot of different jurisdictions, which has, leads to a lot of transfer restrictions. But two, if you're interacting with the banking system, you can't pay people that aren't KYC'd, right? And so even if you're offshore outside the United States, not just the United States, but a lot of different jurisdictions, whether it's Singapore, Europe, et cetera, will have issues with that, right? And so, if you're a centralized, provider, it probably doesn't make sense to be doing something like that.
Right. Okay, let's talk for a moment about. We've talked mostly so far about more centralized stablecoins. There's also decentralized stablecoins. Are decentralized and centralized stablecoins competing against each other, or is there a long term where both will exist?
Yeah, I think there's a long term where both should exist, right? So you talked about how centralized providers probably shouldn't be paying out interest or paying anyone that isn't KYC. Well, decentralized stables can do that, right? And so if you're looking for a yield bearing stablecoin, the best one is probably a decentralized product, right? What I'd also say is people sort of lump all these stablecoins together as like sort of one amorphous thing, right? They're all very different. The way that I like to think about it is like the fixed income market, right? Like if someone wants to buy very low risk, low yield, safe asset, they buy a 1 month treasury. If someone wants to earn more and go further out of the risk curve, they buy a junk bond or a corporate bond, whatever. And that's sort of how I view this. It's a spectrum, right? Or the centralized issuers are at the lowest risk end of the spectrum, and then you can sort of pick your poison or pick your assets, so to speak, and go further out on the risk curve if you want to be having more interesting assets, like in Athena, right? Where you can be getting 20, 30, 40, 50%, depending on what the market environment looks like, and you're taking some risk, a little bit of risk there, right? There's like a 7-day lockup if you want to stake it and earn it, etc. But I think there's definitely a world where these continue to exist, and in many ways, decentralized stablecoins are partners of ours. So one of my co-founders, Drake, was the lead dev at Frax. We're very close with the Frax team. A lot of decentralized stables are consumers of centralized stablecoin products, right? Because they need a product that has really good and seamless fiat on and off ramping, but is also really safe and a stable unit of value. And so we work with many of these providers. A lot of them are using USDC or USDT today. We'll expect them to start moving over to AUSD because with them the rent is going to Circle and Tether.
Why wouldn't they? Right? Why wouldn't they move? Right?
It's a no-brainer, especially if if you have LP positions in Curve or other things. And so they're really good partners of ours, and I think we're going to be great partners to them too, right? There was once upon a time when Frax had 300 million of USDC, right? Well, imagine if that was AUSD or another asset that wasn't really rent seeking on that. So yeah, think there's a world where they both continue to exist and decentralized stables will thrive.
Yeah, I completely agree. You brought up earlier that in the early days, Bitcoin was money on chain, and
Yeah.
now ETH has become more money on chain, at least within the Ethereum ecosystem and all of its L2s. And there's an ongoing debate of whether or not ETH is money. And I don't mean ETH is money as in like you're ever going to buy coffee with it. That's not the purpose of ETH. But uh, within the Ethereum ecosystem, ETH does play a significant role as being collateral, as operating trading pairs. It's money to buy NFTs within Ethereum right now. Not that NFTs are booming or anything like that, or many people are buying them. But I think my question to you is, what do you think will be money long term on chain? Will the Ethereum continue to be money within the Ethereum ecosystem, or will eventually everything will be stables?
Yeah, I think one point to call out first, I think this market is going to all grow as a whole.
Mhm.
What I do think that it'll happen is stables will start to capture some of that market share in terms of moneyness from governance tokens on chain today. Um, and there's a number of reasons for that. I think basic reasons is it's a lot simpler for users to understand. Okay, I have $10 here in my account that I can use for gas fees. It's not a price volatile asset. Um, and like that's just like a better user experience, and it's something that people are used to in their everyday lives like today, right? So I do think that stable coins will start to be used for gas much more frequently and take over some of the use cases that governance tokens serve on L1s and L2s today for sure. But I do think that many of these governance tokens will continue to sort of be money for that chain. But I think this isn't like I don't think this is a zero sum game. I think this market is going to continue to grow. Activity on blockchains will continue to grow, and so even if stables start to take more and more share, they're not going to consume 100% of it.
Um, let's just zoom out for a second. So stable coins reached about 180 billion, I believe, in the last cycle. Now we're getting up close to 180 billion again. I don't think we're quite there, but we're close to that all-time high level. When you look at the adoption of stablecoins, where do you think we're at right now? How do you think we're doing within this cycle and throughout the past few years? And then, like, where do you think we're going?
Yeah, so fiat stablecoins are actually at an all-time high, right? Because that 180 number includes like a lot of these algorithmic stables that completely blew up,
Mhm,
right?
mhm.
And so we're actually at all-time highs when it comes to fiat backed stables. So I think, where are we today? I think stablecoins are the stepstone to broader tokenization over the next 10 to 20 years. And they're not just like a 10x better product, they're a 100x better product than the status quo today of moving money cross border and accessing dollars, right? So beyond usage in DeFi and trading and all that stuff, there's real utility that stables can bring to society and are bringing. And we're seeing a lot of cross-border payment companies, B2B payment companies approaching us about using and integrating AUSD for their platform. I think this is just the beginning. I think the Eurodollar market, which is over 15 trillion, will get completely eaten by stablecoins over the next 20 years. So the $180 billion number today, I see, I see it 100xing, certainly 10xing within the next 5 to 10 years, but I think it'll 100x over the next 20 to 25. And we ultimately want to win market share because we believe that this is the best model, and be number one, given that we're actually uh, you know thinking about like value capture in an entirely different way and actually pushing it back to all these businesses that are opt into our network. But it'll be, I think, a market where you'll have 5 to 10 very large providers, similar to financial services and asset management today. But I just view this as really the beginning.
And because it's the beginning, I think the interesting thing to understand is it's very easy right now to think Tether has won, right? They're dominant. They're so big, so much bigger than anybody else. Nobody else is even close. I mean, I guess USDC is maybe a quarter of the market cap that Tether has. But the first doesn't always win, because often the first is built on the tech that they have at that time and the ethos of that time and the decisions of that time, not without knowing what can happen. And that's what's interesting about stablecoins to me now, is I think we're seeing a lot of products be built now that weren't built 10 years ago when Tether was first built, because they just didn't know or didn't have that foresight
even
that we have now.
exist.
Exactly. Yeah.
ETH and DeFi literally did not exist when Tether started, which is crazy.
That is crazy. So why has Tether done so well?
I think there are advantages to being first mover. I think they understand their core user persona well. I think the USDC and USDT user personas are not 100% overlapped. I do think there's a large portion of Tether users that would use like an institutional grade stable like us or USDC, because you saw when Circle depegged, 20 billion went from USDC to USDT, right? So those were clearly users using USDC that then went to USDT. And so I think there's a little bit of a mix there, but I think they've also managed to, I think, instill more trust in their product over time, right? They met like a very large amount of redemptions last cycle. They haven't had a depeg, like I just mentioned, right? Like that depeg for Circle was pretty traumatic to their business, because 2 billion went from USDC to Tether in the span of like a month, right? And I think people forget this too, right? And you sort of like almost like bury the lead, but like USDC was getting close to surpassing Tether. Like it looked very clear for a long time that Circle was gonna pass Tether, and then obviously that happened, and they haven't really recovered since then. So we'll see. But from my perspective, the next 100x for these assets doesn't come from BTC and ETH trading, which is where USDT is particularly strong. And so I think there's an opportunity for us or others to lean into what we believe the 100x markets will be for blockchain. And so that's why, from day one, we knew it was important to be institutional grade. And so we have one of the largest GSIBs in the world that manages our assets. Then we have an asset manager that makes the security selection, which is primarily overnight reverse repo and 1 to 4 week T-bills, so nothing too crazy, very vanilla, and that enables us to scale to $1 trillion, like if we need to, because our bank, our bank has a balance sheet in the trillions of dollars, right? So where with these regional or small banks that you're kind of getting with these low tier providers, like they can't even scale to like 50 or 100 million of assets. And so it's important to be institutional grade from day one. And I think that's also why we're seeing a lot of interest from not just crypto businesses, but traditional businesses so early on in our journey.
I've got to ask, just since you brought up a follow-up question there, is where do you think the next 100x is when you step back and you look at crypto and blockchain space, and you're obviously deep in it and attending all these conferences and seeing a lot of things being built, but we're all still waiting for what is going to bring on the next wave of users? Where do you think?
I don't want to get too into the details and and give away some of the stuff that we're doing, but what I'll say is I'm a big believer that blockchain is eating will eat financial services and payments, all of it. Banks, traditional exchanges, custodians, FX. And if that's your thesis, there's a few areas where it's obvious to lean in, right? Because you think that blockchain-based rails will take over some of those markets and market structure. And so that's what we're planning to do. We'll have some, I think, fun announcements early next year, or maybe even later this year, around some of the markets that we think will 100x. That said, we're still leaning into where crypto is today. Most of our customers and pretty much all of our usage is coming from crypto native businesses and applications. And so we want to grow with them, and we have very good relationships with all of these different ecosystems where we've deployed, because that's also something that we're believers in is fiat stables are the most important asset to any ecosystem. And you kind of have this duopoly where one player doesn't really interact with anyone, and then the other is has this sort of single partner model with Coinbase. And like we can be a close partner to everyone. Everyone wants to be have a relationship with their stablecoin provider, and so like that's what we are trying to do. And I think we've done it pretty well to date. And just need to continue to execute. But I think also part of the reason we do well there is because we believe it. And like Drake, came from Frax and DeFi. Joe, my other co-founder, was head of global operations at Galaxy for the last 6 years. And so, I got into crypto in 2016. Got Van Eck into it back then. We've been in this space for a long time and care very deeply about it and its participants.
Okay, before we wrap, I mentioned at the beginning of the show that one of the challenges for our audience is we're all investors, and most stablecoin companies are private right now. There's talk about USDC going public, and at that point we can invest in it, not in a token on-chain way, but in regular stock market way. What are the ways that you think that investors can get exposure to, if they believe in the thesis, they buy in, hey, stablecoins are the killer app, I think it's going to 10x, 100x. How could they get exposure to that?
There's not that many avenues today, to be honest. A large amount of the value will be driven towards issuers, infrastructure, and applications. I think though, in ways that investors can get exposure to stablecoins, is because by using stables, you're actually receiving a lot of value back, right? I saw a tweet from Victor Bunin today. Coinbase, he's transaction fees are going to zero, right? What he means by that is if you use your Visa or MasterCard today, you don't see this, but the merchant pays 3%, right? And what they do is then they just raise the price of everything to pass that cost on to consumers. But by using stablecoins more and more in your daily life, you're actually going to capture a lot more value in the long term. And I know that this is a little bit theoretical, but because you're getting rid of all these middlemen in the system, right? And this is also why it is 100x better. Because if you're a business moving money cross-border today, and you send it from your account in Mexico to an account in Singapore, it could take days, where the bank is then earning income on it, and also you don't get it right away. It's ridiculous. Where today it's oh, I'm gonna send 10 million bucks. I see it in the mempool, 1 second, done, it's there, right? And that is 100x better. So from an investment perspective, I think there's, to be honest, not that many avenues available yet, but I think by using stables, you're actually driving a lot of value back to yourself, your business, or just your daily life, right? Which is, I think, part of the beauty of it. But we'll see. There may be, more ways to play the stablecoin game in the future. It seems like M&A in the space is heating up, and there's going to be a lot of eyeballs on this space. So,
yeah, it's so funny you bring that up. I had to take $20,000 in cash out of my bank recently to pay for a new roof, and it took my bank 1 week to be able to give me $20,000. 1 week. I had the money's there, and I had to email them.
You don't actually
and then wait a week. What? You don't own your own money. I was like, what do you mean you have to wait a week to withdraw?
It's unbelievable. I remember this was a decade ago now, but I was tax season, I was lazy, getting down the wire, and I was like, okay, I'll just sell, some equities to pay, this tax expense. And then, I remembered when I did it, I have to wait 3 days for the cash to settle before they wire it to my bank account. And I'm looking at the clock. I'm all right, well, I just snuck in before the deadline, but it's it takes days, and it's just not a good process. It's not composable. And that's why I'm a believer that blockchain is the financial innovation that fintech never really had, and financial services never really had. The last 15 years of fintech has all been demand aggregation, UI improvement, customer segmentation. Even Stripe, which is the largest private fintech today, they're still using all of the same rails that everyone else uses, right? Whereas there's an opportunity to build brand new businesses based on blockchain-based rails, which are 100x better than Swift or ACH or any of this stuff. And so that's I think the outcome here, right, is you get this like 100x from just changing how everything in the world moves, right? Like all the money, all the assets, like that's going to remove a lot of middlemen and make the experience much better for individuals and businesses.
100%, 100%. The other thing I think you could do is, you could invest in the underlying chains that you believe will win stable coins. Now, will one chain will win stable coins, or more likely there will be a whole bunch of chains that win stable coins, especially as fragmentation and liquidity. And I know you guys have a great partnership with Wormhole. We don't necessarily have time, but if you want to chat about it quickly, we could actually.
Well, I was actually just going to say that's actually a good point, right? Is like if you want to get exposure to stable coins, you could look at chains that are very active in the future of finance and payments, right? And there's a lot of things that are important to like those organizations that will lead them to choose a chain. So a few of those things, high throughput, low latency, low transaction costs, ability to have like permissioned environments, teams at the chain level that really understand institutional capital and financial services, who can speak the same language of these people that probably don't know much about blockchain and are coming to those foundations and saying, hey, like, what could you guys do to support my financial services business? If that team gets financial services, they're probably more likely to land them. So yeah, maybe actually, we sort of found a way, right, to get exposure if you believe in the stablecoin thesis.
Well, and the interesting thing about you guys is, you launched on Ethereum first, you launched on Avalanche as well, and then recently you launched on Sui, and that really stood out to me. And really, your thesis that you've just mentioned, high throughput, low latency, I'm assuming that's why you did that. And for everybody listening in, if you guys haven't listened to our stablecoin episode, make sure you go check that out. We did not our stablecoin episode, our Sui episode. We did an episode on Sui recently, so go check that out. If you want to listen about Ethereum, we talk about that every day, so that's nothing new. But was that the reason that you guys launched on Sui?
That was definitely a large part, and also like the team just executed, right? They came from Meta and Facebook, and this tech was built to service a Fortune 100 company that was going to move money around the world, and so we felt confident that it was going to be one of the environments where people look to in the future. We also have a few additional chains coming soon. So Mantle will be this week. Then Injective will be the following week, but that one's a little bit under wrap, so maybe cut that one out. But Mantle will be live on
we'll bleep out that one, and you guys are gonna have to come back.
I'd like to, bleep it. That's good. That's a good one. Yeah. But we, both of those organizations are really focused on financial services and attracting, payment companies, and like the next 100x of crypto. Right. I think, DeFi is in a very good place and will continue to organically grow. But I think there's an opportunity to capture, what'll be the next 100x.
Nick, it's been an absolute pleasure to have you on the show. Thanks so much for sharing everything with us. And shout out to you and your whole team for building in this space, for being entrepreneurs and taking this task on. It's a big endeavor. And we all believe in stable coins. And the more we can spread it, the better off we are. So much appreciated.
Yeah, thank you for having me.
Awesome. Thanks so much for listening in, everybody. If you're not already subscribed, make sure you subscribe because you could win some free stuff. If you subscribe before 10,000 on YouTube, have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note. This show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.